Hello everyone, today is the 12th of August 2026 and after taking a short break last weekend, I'm back with a new important update for you. To be frank, there was nothing I had to add on top of my latest update on Thursday last week here on YouTube till now. And before I begin, please forgive me if the video quality is not great. I'm currently traveling without all the gear I usually use in Hong Kong. So, let's start with the situation in the crude oil market. As I record this, the WTI crude oil price is trading around $84. For the record, this is above the $82 price from last week when Treasury Secretary Bessent went live on CNBC stating that a US-Iran agreement to reopen the Strait of Hormuz was imminent. The market reaction to that statement was, of course, completely asinine. I explained last week that such an agreement would not have restored the Strait of Hormuz pre-war status quo. Furthermore, regardless of diplomacy, it will still take months to find a new equilibrium in case of success. The price move was pushed to the extreme by the usual market manipulation. This manipulation is stretching the dislocation between crude oil paper prices and tangible real-world equilibrium to extreme levels now. Factors still completely ignored by crude oil paper prices include physical supply, level of demand still strong at the current prices, remaining strategic petroleum reserves, and the level of global commercial inventories. Last week, I also stated that Bessent's statement made no sense from an Iran perspective because Iran owns all the cards at the moment and benefits from maintaining the status quo with no incentive to offer an exit from this mess to the US and its allies. Time is on Iran's side as pressure mounts on President Trump before the midterm elections. The reason why the chances President Trump orders a new military strike to break the impasse are rising the closer we get to the midterms in the US. Military strike that, as explained last week, has low chances of succeeding, but not zero. Military strike that Iran is clearly preparing for after the latest round of appointments and restructuring of its military leaders. So here we are with crude oil back to $84. Let me be clear. This level is still incredibly low compared to where it should be. I'm not tired of saying the WTI should be way above $100 or even $120. This is especially true as diesel prices are close to hitting their March highs. After that, they will approach the all-time highs reached in 2022. What concerns me the most in this current situation is the continued price manipulation. The U.S. strategic petroleum reserves has now fallen below the 300 million barrels mark. Despite this, the manipulation of both crude oil future prices and the narrative continues regardless. This increases the chances of a market seizures and a snap to a true equilibrium all of a sudden. The risk of such a volatility event will cause significant global market repercussions. We are observing that yields on US treasuries are not coming down at all. Interventions on the Japanese yen are being quickly reversed and are failing because Japan imports 100% of its oil and must pay for it in US dollars. This, on top of Japan's long-term structural monetary problems, is pushing the JPY to depreciate nevertheless. Furthermore, an abrupt spike in energy prices will have incredible consequences for industrial companies. The economy as a whole could come to a halt as a result. 24 hours ago, the usual manipulation persisted with another fake news story. This fake news came from a Pakistani source again, claiming the US was close to some sort of agreement. I mean, what are you even talking about? Some sort of agreement? Look at the chart I posted yesterday on X for a clear explanation. The fake news was planted to crash oil prices low, allowing insiders to profit. Insiders positioned themselves an hour in advance to benefit from the move. Then the headlines dropped, triggering dump trading algorithms to crush the price already set in a downward momentum. After another hour, those who went short before the news began to cover. You can observe this by the price move and the corresponding increase in volume I highlighted in the chart. These shenanigans and manipulations can only buy a limited amount of time. They will surely not refill the crude oil inventories that are emptier worldwide. Other indicators like the price of diesel show real supply tightness in the market. This tightness can suddenly surface in the real economy with real shortages. Meanwhile, we continue seeing Iran striking ships that try to cross the Strait of Hormuz via the Omani lane under U.S. military escort. The Houthis are striking Saudi Arabian ships and Aramco oil facilities in the region. For example, the Jizan refinery, hit 2 weeks ago, won't resume operation till the end of August, while last week, Saudi Aramco CEO claimed the company faced no significant damage from Houthis attacks. Clearly, that is not the case and he lied, or they wouldn't keep the facility shut for weeks. Furthermore, more news come from refineries in Libya and Russia being struck. Other refineries are running at near 100% running rate and had no maintenance this year, with increasing reports of incidents in refineries around the world because of that. To conclude this section, the US government has to do something to rebalance the situation soon. It is clear they have no alternative other than launching a second military strike. That option has a very low chances of success, but they are not zero. In the second part of today's update, I want to quickly touch upon the silver market. There has been a lot of social media and mainstream media buzz about it. The reason why I published an extensive update for my premium subscribers on Slice. In the update, I explain why I don't see the current move in silver as sustainable yet. Both silver and gold will be highly sensitive to a real oil supply shock that is still ahead of us. All indicators show the current demand for silver is speculative and not for the physical metal. The shape of the future curve, lease rates, and growth in exchange physical inventories confirm this. This is another burst of speculative appetite after silver reached technical lows, but not change my short, medium, and long-term outlook for silver and gold I shared many times in the past months. I expect both metals to be sensitive to liquidity in the short term. The speculative liquidity will be drained once an oil shock unfolds. As I said weeks ago, this will actually create the real low in gold and silver. After that, both metals will be very bullish in the medium and long term. If you are interested in more of my premium content, you can find the link to subscribe in the description of this video. On my Slice portal, I shared many updates on crude oil, trade ideas, a trade idea for natural gas later this year, and I also shared my first tutorial on how to trade and use options to pursue trade opportunities. Thanks a lot for listening to my podcast again today. If you want to support my channel, please don't forget to like the video, subscribe, and turn on the notifications not to miss my future update. Thanks for supporting me on X and for reading my research on justdario.com. I wish everyone a great day. Bye.